Hello everyone and welcome back. In this video, I'm going to be going over 3 reasons why I enjoy dividend investing, and maybe these are some of the reasons why you enjoy dividend investing also. So when it comes to dividend ETFs, I do own 3 dividend ETFs. That's SCHD, JEPI, and from my growth portfolio, I do own the ETF VIG. So primarily I am a dividend investor. About 75% or so of my total portfolio is in dividend ETFs. So reason number 1 why I enjoy dividend investing is the consistency of payments. As you can see here is the history of payments for my income portfolio. And JEPI is a monthly dividend payer. So you're going to see that every single month I am going to be getting paid a dividend. And then for SCHD, it is a quarterly dividend payer. And then for my growth portfolio, this is the history of dividends, pretty much similar to the income portfolio. These are very consistent. I get paid quarterly for both of these ETFs. So no matter what quarter it is or even what month it is, I am getting paid a dividend, whether that be from JEPI, SCHD, or VIG. And I even get paid from QQQ, which isn't really a dividend ETF. It tracks the NASDAQ 100, but even that ETF and those stocks do pay dividends. So here is the NASDAQ dividend history for the ETF SCHD, probably one of the most popular dividend ETFs there are. And I am just going to use this as an example. I am not going to go over every single ETF that I have because that would be a little bit too much. But as you can see, these dividends are very consistent quarterly, every single quarter, no matter what the economy is doing, no matter what the market is doing. It doesn't matter. And as you could see, these dividends are not only consistent, but generally they do grow year over year. So for example, you see on December 18th, 2017 here, that the dividend was about 35 cents a share. And then a year later, it was 40 cents a share. So consistency and growth, which I am going to get into next. But I think that most dividend investors love that consistency factor because no matter what the market is doing, most of these ETFs, if they are designed for growth, they are going to be paying out increasing dividends no matter what the general sentiment in the market is. So getting into reason number 3, as I said before, it is dividend growth. And now each of these ETFs, basically not every single dividend ETF, but the majority of them do pay growing dividends. So as you can see, this payout will grow over time, year over year, consistently in a general sense. It generally in SCHG sense grows over 7 to 8% no matter what the market is doing that year. So that is a great thing because think of it as you getting pay raises every single year. And the way that this grows is much more significant generally than inflation. It is definitely more significant than most people's increases for their wage at their job or those on fixed income. This is going to increase at a faster rate generally than all of those 3 things. And I think that that's why some people really do enjoy it because they know that this keeps up with inflation and then so even more. So over that 10-year history, we do see that this grows very nicely over time. Again, no matter what the market is doing, even in times of uncertainty, it generally grows and it is basically displayed very nicely in this bar graph here, how your dividends increase over time. Now, reason number 3, and I think that this is probably the number 1 reason why dividend investing is so great. I think that this is probably the best reason, and maybe some people agree as well. But when it comes to passive income, I don't believe that there's any better form of passive income than dividend stocks. And although this is, I guess, a list of general passive income, dividend stocks are listed as number 9, but if you take a close look at all of these passive income ideas that this website suggests, none of these ideas are really truly passive income. Most of them consist of actually starting like a small business or something other like that takes up a lot of the time. Like here, number 18, of course, it's what I'm doing, and that is a YouTube channel. It is not necessarily passive income. Of course, it takes time for me to make these videos. There's editing process, there's recording process, time to make the thumbnail, and so on. So it's not really passive. You're basically doing a lot of work up front. For in a certain case like me, people don't even really get any income for, at least not initially. And a lot of these other things are pretty similar. Like if we look at another example, we see a rental income. Well, that basically means you're buying a property, you're renting it out. You might have a property manager, but you're probably still making an LLC. You're doing renovations possibly. You might still have to deal with the tenant even with a property manager. You might get sued, who knows. It is not really passive. Write an ebook, of course, that's not really truly passive. Once it's written, you might get some money far off in the future when you don't have to do anymore. But a lot of these ideas are a lot of upfront work. Like flipping retail products, for example, they say it's a form of passive income, but you're going to the store pretty much all the time and then flipping these products or Goodwill or whatever it is, sell photography online. None of this is really passive because, of course, I guess you're taking pictures and then selling it. It doesn't really sound passive, seems like a small business. There's some other things that might truly be passive, like a REIT, real estate investment trust. That's another thing you can invest in that's hands-off, or invest in a high yield CD or savings account. So these are truly passive forms of income that you don't really have to worry about. But a lot of the passive income ideas that a lot of people push aren't truly passive income. I know one popular form of passive income that's pushed is vending machines. That's not on this list, but that's not really passive. You gotta go and get the locations, you gotta stock everything. Maybe eventually it gets to the point where it's passive when you're so well developed that you have employees doing everything and you have, your business manager doing everything, and then you just get a paycheck from it every month or every week. But generally these things are not passive. And when it comes to starting those passive income businesses, you can either try to start a business that may or may not work out, or you can invest in an ETF like SCHD, and you basically buy 100 of the stocks that comprise of this ETF. And these are all very well developed businesses. They are all getting a revenue consistently. These are all good companies, rain or shine, they're getting money. So when you're putting your money into like dividend ETFs or even dividend stocks, I suppose, you're completely hands off. This is not something that you have to even deal with. Somebody sues the company, you're not dealing with that. The business operations you're not dealing with, you're not hiring employees, you're not getting capital, you're not seeing what location you can start at. You're basically buying these amazing companies, and it's hands off from there. You get your dividend every month or every quarter, and that is that. You can put your feet up and relax. It is the most true form of passive income there is. And I know that I said 3 reasons why I enjoy dividend investing, but here's a 4th for you as a surprise. Dividend investing generally is seen as more conservative, or at least less volatile, than investing in a general market. A lot of these companies are well established, so they do deal with declines a little bit better. So here's a back test between SCHD and VOO, which is an ETF that tracks the S&P 500. This goes from January 2012 to January 2024. And as you can see, the overall standard deviation was slightly less for SCHD. There was a better worse year, and the max drawdown was a bit less. And just for another comparison, I did the dividend ETF VIG, which is the ETF that I own that I showed you before. And this even has less of a standard deviation a bit. I think that this is a little bit different. This goes from January 11 to January 24. And the standard deviation is even less. It has a bit less standard deviation. It had a lower worst year and a lower max drawdown. So a lot of these stocks, again, are more conservative. They're a lot more well developed, I would say, and they are generally impacted less in negative market conditions. So that's kind of why a lot of more conservative investors like to invest in dividend stocks rather than the overall market or even QQQ. If we look at QQQ from January 2011 to January 2024, you see, of course, it did outperform the S&P 500, but that standard deviation was far more. It had a massively worse max drawdown and a massively worse year. So, of course, you're going to get those greater returns, but much higher volatility. Some people don't really enjoy those stomach churning drops. Other people are a bit younger. They can weather the downfall, but some people do like that conservative nature or that defensive nature of dividend investing. So let me know what you think, everyone. Why do you enjoy dividend investing if you're a dividend investor? And if you're not a dividend investor, give me some reasons why you don't enjoy dividend investing. Maybe it's because they don't grow as much as other types of investments. And if you did enjoy this content, definitely leave this video a like and subscribe for future content. And I will see you all in the next video.